I'm financial coach Sparkle, but you might know me as musical artist Karma Soleil. And welcome to Financially Sparkling, where I teach you to fire in your finances and to sparkle in your life. Well, get your notebooks and let's get into today's topic. Today's topic is a great and really easy investing option for beginners, which is index funds. Now, I will need my notes for this because this is a deep topic and a lot of people get confused whenever we talk about investing. So before we begin, I have to put my disclaimer here. I want to remind you that I am not an investment advisor, an investment consultant, or any kind of investment professional. I'm an average person that has learned about investing through my own trial and error. I've read books, I've taken courses, and I have applied my education to my own personal finances. I personally prefer to DIY my investments and have control over my money. However, if you don't feel confident to DIY your investments, seek professional advice if you need more information and assistance. Luckily for you, the websites I will mention today have brokers, traders, and professionals ready to help you. But do your due diligence and research them to make sure that they are working in your favor and not theirs. There are some brokers and investment professionals that try to take advantage of us people, so you want to make sure that they're looking out in your best interests. And I'll go over some of those things to look out for later. And you can always find all of this information on my blog to help you out. So let's begin with talking about index funds. Index funds are similar to a high-yield savings account, but they come with risk. They are an average risk investment option and they have some passive income benefits, for example, dividends, share prices, and so on. I will just describe the passive income benefits today. In the future, I will give a brief introduction about stocks and investments, and I'll go further into detail to educate you through this process so that you're not caught off guard like a deer in headlights. Index funds are a group of funds, like mutual funds, electronic traded funds, like the ETFs, and they hold pieces, which we call shares, in a variety of different sectors: technology, health, food, and so forth. These are considered an efficient and sometimes called a safer investment option because you're investing of a piece of everything all at once. So, for example, if the medical sector has a bad year, but the technology sector has a great year, you'll lose some money from the medical, but you'll gain in technology. So it's a self-cleaning kind of system and it starts to balance itself out. Now, to see the maximum benefits, in other words, your return on your investment, your ROI, it is advised to invest between 10 to 20 years. Now, it's gonna look bad sometimes at the beginning, but you need to wait at least a year to see if you've actually gained and what have you gained. If you don't have enough money to eat or pay the rent, I do not advise investing in anything. Your survival comes first. Remember that. The best way we invest is when we have money to invest into. So you do have to have money to make money whenever you're investing. But let's continue on. Let's talk about some brokers that can assist you with investing into index funds. Now, Fidelity Investments is one of my favorites. I can invest, manage my IRA, and save all in one place. Fidelity also has their own index funds that are commission-free, which means you don't need to pay a broker fee to buy them. Yay! A few Fidelity Index Fund names are the Fidelity 500 Index Fund, the Fidelity Zero Total Market Index Fund, the Fidelity Large Cap Growth Index Fund, and there are some Vanguard equivalents to compare: the Vanguard 500 Index Fund, the Vanguard Total Stock Market Index Fund, and the Vanguard, let's see, and there's others. The Admiral shares, there's the one. The Vanguard Admiral shares. So there are many more. Try to compare expense ratios. These are the management percentage fee that you will pay them to manage the collection of the fund. There's a manager of each fund. So look at those expense ratios. That's the percentage you're paying them to manage this fund. And then you want to look at the annual percentage yield. This is the average percentage amount that you can expect to earn. I'd like to add that in general, you can expect to receive about a 7 to maybe 9% return on your investment over the 10 to 20 years. Sometimes it's higher, sometimes it's lower, but that's just the general average. So when you're doing your investment calculator, try to put in 7%. And you can play around with it and put in 4% just to see how much you would have made with all things considered. Like if the market doesn't do so well, you might have only made 4% over the course of a 10-year time. But the general average up to now has been about 7 to 8%. You will see your portfolio increase. So this is a bigger jump than what we usually see in our banks and our high yield savings accounts. That's why a lot of wealthy people invest into the markets, because the more you have, the higher that number goes. And sometimes it's going to be a very good 10 years. So you can see an annual percentage yield of maybe 10%, 14, and it can go up. You can see great benefits. It's all volatile. It's all ever changing. So I always err on the side of caution, and I calculate for between 4% to 8%. I think realistically when I'm doing my calculations with my portfolio. And I'm still happy with that, because that means that even if I do lose some money throughout the years, I know the average that I have earned over a 10-year time span will be 4% higher than it was when I invested. So technically, I really haven't lost anything. Now, unless another Great Depression happens, which I hope does not, this is a good option to do if you want to build wealth. Seeing these two things will give you some guidance on which stock you should choose. So for example, if the expense ratio is very high and the annual percentage yield is very high, you know you're going to be paying someone to get a lot more. You have to do your math. You have to say to yourself, okay, do I want to pay more to get more? But this more is not really more because I'm already paying more here, but I haven't earned something yet. So you want to do a little bit of deductive reasoning here, like logical reasoning. So remember, the past is just a guide and it will not predict the future. You can look at old stock prices and stock patterns. You can look at everything that's old, but it's just a guide. It won't predict the future. Nobody can predict stock future. Do not believe anyone that says, oh, you should buy this share because it's predicted to be. Predicted by whom? Are you God? Nobody can predict the future. You can only make an educated guess. So comparing different funds' histories can help you make that educated guess. It's all a guessing game after all. The stock market is a gamble, but it's a gamble based on human behavior. So when you know how people work, you can make a guess about where this is going to go. So I do have a screenshot here that I took from February 6th of 2024 this year of two separate stocks, the Fidelity and the Vanguard. And both of these funds have approximately 1,200 to 1,300 shares of the entire market, which means they have a little bit of everything that's produced, which is a good thing. That means that your money is not going into one thing. So if that just fails, you're broke. You don't want that. You want something that has a piece of everything. So that if that one thing fails, you've got 1,299 left of that 1,300. That's a better place to be in than if you put all of your 1,300 into one. You don't want to do that unless you like to be risky and take big risks. I'm not that big of a risk taker. So definitely do the other one if you want to have a lower risk tolerance and you don't want to have a heart attack today. But let's look at this photo. You will notice that Fidelity's fund is newer than Vanguard's, but they are both rising and falling at the same time. Yet they are rising consistently, almost equally. So when you look at something like this and you see the rises and the falls, it's going up. It's rising and falling up. Remember that. There have been a few cases in history where it did not rise and fall upwards. I think there were 2 times in history, like the big stock market crash of the early 1900s, where it just crash, and that led us into the Great Depression. So that's one time. The other time we most often know as the other 2 recession times. Now, it hit hard, but if you stayed in the market at those times, you would have come out ahead. You have to understand that the stock market is full of ups and downs. It's a lot like life. It's going to be up and down, but you're still going to be alive. And sometimes it'll go down hard and you'll have a hard time, like you will go into your own personal depression just like the stock market does. So you have to acknowledge that. Once you get out of that, once you pick yourself up, once the markets get back to where they need to go, they're rising again. Just understand that they rise and fall very naturally in a similar way to us as humans. And once you understand that, you can rest at ease a little more when you look at the price and you say, oh, my share price, damn it, it went down $100 today. Well, in 2 weeks from now, it'll probably be back up at $250. Be patient, have faith, and if this kind of stress is just too much for you, you don't need to do this. There are other ways, there are different styles of earning more on your money. Like we talked about, we have the index funds, you have bonds. There are other ways to make sure that your money is protected against inflation. That's the main reason why we invest into the stock market to begin with. And some people, they like to turn a quick profit. We call these people the day traders. They are the types that are sitting there daily just trying to buy and sell. When it's high, they sell. When it's low, they buy. Those are the day traders. But us normal, everyday, average people, we don't have the time of day to sit there and look at stocks all day on the computer. No, we do the long-term game. We want to make sure that we're going to be okay in our retirement. And there is a stock for every kind of need. There's crowdfunding, which is another way to invest. It's like venture capitalism. People want to invest in your company. You can be one of those people that invests into someone's startup. There's different ways of investing. You just have to choose the one that works for you. So let's go into the other types of brokers where you can have or buy your own index funds. Vanguard is also a favorite of mine. Thank you, Jack Bogle, for pioneering the index funds. So Vanguard I like, and Fidelity I like. I'm currently with Fidelity. Then there's the TD Ameritrade. There's Robinhood. You probably heard about this Robinhood thing when the GameStop AMC debacle happened in, 2022? I knew it was during COVID. That whole time is a blur for me. But we remember the GameStop. Then there's Edward Jones, BlackRock, TIAA, UBS, and Charles Schwab. Now, if you do have a Netflix subscription and you actually use your Netflix subscription and it's not sitting there just taking money away from your bank account, I highly recommend watching the documentary series Get Smart with Money. In this series, 4 financial coaches, like myself, help different people with different income statuses to help them save and manage their money. You can also check out the I Will Teach You to Be Rich by Ramit Sethi on his Netflix show, How to Get Rich. His show and YouTube channel and book revolve around the theme of asking you, what does your rich life look like? He gives you a step-by-step guide to help you improve your financial life. So if any of this has been helpful for you, please leave a comment below if it has been helpful, and also leave a comment below if you're still a little unsure, and we can probably do a one-on-one financial coaching session, or if enough people are confused, I will do another video and go step by step through it to help you all, because this is not as complicated as we have all been led to believe. It is very simple, but remember to check those expense ratios and the annual percentage yield. Expense ratio is how much you're paying them to manage the fund, and the annual percentage yield is how much you can expect to receive. That's it for today. You can find all of this information on my website and my blog. The link is in the description below. Everything is free except my time. I do private one-on-one consultations at a very low cost, meaning if you need some help with your personal finances, you can always book a session with me through Fiverr. See you next time, and keep sparkling.